Hello everyone and welcome to the Quantpedia Explains Trading Strategies video series. Today we will discuss designing robust trend following system.
Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. Today we will discuss trend following, and we will discuss an interesting trend following paper written by Dobromir Sotchev from JP Morgan. And it will be about how to design a robust trend following system. Trend following is a very popular topic. We in Quantpedia we have around 80 strategies in our database, so it's around 7% of our whole database. A lot of you probably know what the trend following is. So you are buying the assets that are going up and you are selling the assets that are going down. You diversify among a lot of the assets and you can use different weighting methods and different signals, etc. etc. This paper that's called Designing Robust Trend Following System is reviewed on our webpage, on our blog, and I would like to discuss this paper with you because I really consider it very interesting. What is the paper about? It has around 40 pages. The whole paper shows you how to design an interesting robust trend following system. The paper starts with the theoretical introduction, what the trend following is, how the trend following works, etc. etc. And then it goes into the theory. It explains what is similarity between the trend following and between buying the options, especially buying the straddle options. So when you do the trend following strategy, when you buy assets that go up and when you sell assets that go down, you earn a lot of the money in case there is very strong trend. And something similar happens when you buy the straddle. So when you buy the straddle, you pay a premium upfront, and when there is a strong trend in the underlying prices, you gain some money. Of course, when you buy the straddle, you must pay premium upfront. So when you have like a systematic trend following strategy, is a little better because you do not need to pay any premium upfront. So I mean, the trend following and options are very similar to each other. So the paper goes into the theory why it is so, etc. etc. Then the paper discusses different trend following signals. So there are a lot of the signals that you can use for trend following. You can use the binary signal, you can use Z-score measure based, signal based on the T-stat, etc. etc. So then the paper once again goes is a little theoretical, explains what is the payoff structure when you have the trend following strategy or when you are buying the options, so when you have the straddle, and the payoff is nearly the same. It shows the differences between lookback periods, so between the short lookback period or longer lookback period, etc. etc. In my opinion, the next important section is the net P&L. So the paper goes deeper because when you trade some system or any strategy, it is not without the costs. And the costs are, of course, slippage and commissions that you need to pay to your brokerage. What the paper shows is what is the impact of the cost, what is the net P&L, and runs some simulation and some statistics. And then the paper checks what is the optimal lookback period selection. I mean, if there is some idea how to select the optimal lookback period for the trend following system. And then there is a prototype trend following solution. Paper selects investment universe and builds trend following system on all sub-universes. So investment universe consists of futures that are divided into 4 sections. So into commodities, equities, rates, and FX. You can build trend following strategy in each of those sub-universes, and then you can mix them together. So the paper propose simple trend following strategy and shows the statistics, performance, Sharpe ratio, drawdown, volatility, etc. etc. And then there is a lot of the pages that goes deeper into the variation of the basic strategy. So the paper runs a robustness test and checks what is the impact of various lookback periods. So if you have a short lookback period, longer lookback period, I mean probably the optimal lookback period is around 1 year, and that's the lookback period that we are also using the most often in our own strategies. The afterward there is a robustness testing showing what is the performance of strategy when we change the signal. So what is the performance of strategy when we use the Z-score or binary or delta straddle signal. Afterward, there is a discussion about what are the diversification properties of trend following strategies. So when you mixed up together the trend following strategy and passive long only portfolio that holds the underlying assets, there is a clear difference in performance. So the trend following strategy helps to offset the losses of the long only portfolios. So that's the main added value of the trend following strategies, because you are allowed to go short systematically and it can help you to offset the losses in just right time. Afterward, there is a discussion about the risk budgeting. So that's a very important topic for the trend following strategy because it's really important. There are like various weighting methodologies that you can use. You can weight equally futures in your portfolio. You can target volatility of your portfolio. You can weight your futures based on the past volatility, etc., etc. The paper suggests using hierarchical risk budgeting approach, which is like the common approach and used very often in academic research. That's the weighting. Then there is important to control the cost and reduce the turnover costs. So it's really nice feature to have the system that doesn't trade very often, and the paper suggests how to reduce the transaction cost by reducing the turnover. After that, there is a discussion about how to adjust for the carry. That's like very interesting topic because trend following system usually use futures, and in the futures you can earn money by holding the futures when the futures curve is in degradation. So when all of the future contracts in the future have a lower price than the current contract, and when you roll into the next futures, you buy the futures for the price that's lower than the current spot price or the price of the current futures. And by this rolling into the lower priced futures, you can get like extra income in the form of the carry. And what the paper discusses is how to optimally adjust the performance, or how to optimally adjust the strategy by consider this carry return in your trend following strategy. All in all, I would really recommend you to review this paper. I mean, we reviewed this paper on our blog. I would say that's a really popular and interesting paper. And if you are interested in trend following strategy, we really recommend review the paper. If you like this video, if you like the paper, please give us the like, please follow our channel, or you can follow us on other social networks. Of course, there are a lot of the other videos and all of the other articles about trend following, about the option trading, about the momentum, and all of the other quant stuff on our webpage. So feel free to visit our webpage and look through our webpage. Thank you very much, and I hope that you will join me in the next video.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.